Hi everyone, welcome to Naked Money, episode 2. Just coming out from Valentine's Day, and Valentine's Day is after the Family Day in Ontario and some other provinces. And we're getting started on our episode 2. I'm your host today, Ahilan Balachandran, a certified financial planner and founder and CEO of LifePlan Investments. Today we have a guest, ABINAN from Legend Financial. Naked Money is about truth about money, without filters, without any agenda, talking about the money and the concept that you need to know about some of the areas of the finances you do with the money. So without further ado, I would like to ask Abi, give you a little idea about who you are and what do you do.
So I'm Abby from Legion Financial Solutions. I'm a mortgage broker, right? We also do private lending.
Mm-hmm.
So I've been in this field for about 6 years now, starting from working with a tier 1 bank. I worked for a MIC, which is just another alternative private lender. Worked the broker side, so the whole spectrum. And I can say there's a lot of questions you probably have. There's a lot of things to discuss, and there's a lot of things that people out there, especially the general public, do not know about.
Exactly.
And you know what, when you ask me saying, hey, let's get the truth out about every nitty-gritty detail, I was like, this is great, because the public needs that knowledge and needs to be aware of certain things going in and out of mortgages, right? Or any other finance for that case.
Yeah. Thank you, Abby, for coming. So let's start with the bigger part of today's crisis. I mean, because of the housing market and the lending criteria and being in the lowest interest rate environment and the economy itself. Mm-hmm. So we have some challenges for millennials and Gen Z to getting the first homes or condos they own. Yeah. So, what are the challenges you see when you're working in the millennials clients, and how you, as your team, how you actually able to help them with the 3 different major lending criteria, right? Yeah.
So a lot of which actually my career shifted when I said I went from a tier 1 bank and I left and I went into the, let's call it the private / broker realm. One of the major concerns that I had and why I even did that shift was because a lot of the young generation, Gen Z, millennials, they were all having trouble getting qualified at a tier 1 bank.
Exactly.
And some of them had good income, so not all the times it was an income. Sometimes they had good income. They had the down payment, right? The only issue was the fact of too much debts. They might have OSAP, right? Some of them went and bought vehicles in university, right? They have a car loan. So a lot of these things that people don't know is that these loans, right, these monthly payments, the more monthly obligations you have, the harder it makes you to get approved for a mortgage loan.
Exactly.
Right? So one quick thing that people don't know is we always advise this as mortgage professionals. We say, buy the house first, then buy the car. Okay? And I think this is the biggest mistake a lot of people do, is because, they need to get places, right? A to B, they got a new job, they're making, let's say, a starting job of 60, 65K, which is pretty good for a university student, fresh grad, right? And the first thing they want to do is buy a vehicle, right? And obviously they're not going to go buy a used vehicle off Kijiji for 5, 6K. No, they want the newest whatever car out there for 60K and they do the monthly payments, right? They can afford it, yes. But there's certain ratios that we have to look at whenever we're dealing with the banks, right? These are called your TDS and GDS ratios, right? So the GDS ratio is basically anything to do with the specific property. So the property tax, the heating cost, if applicable, the condo fees, like you mentioned, right? The monthly mortgage payment that's going to come, right? The stress test. TDS is all of those lending criteria to do with the house, those ratios, alongside every other debt you may have. OSAP, car loan, maybe you co-signed for somebody else's house.
Yeah, that's one of the biggest things, right?
Biggest things, right? Yeah. A lot of people don't realize when you co-sign for somebody, you are putting your credit on the line for them.
Yeah.
So the name and everything, this is the biggest thing. Some people will say, I signed for my cousin's car, but it's their car. They signed the papers. It's in their name.
They own the car, but you're
the one liable, right? So that's the issue, and so it goes back to saying, I tell people, get the house first, then deal with the car, right? Going back to my first point, because a lot of people make the mistakes where they buy the car and now it hurts their, let's call it their affordability in the ratios for their mortgage.
Yeah, yeah.
Get the house, you could walk into any dealership, they're gonna give you the car, right, and the loan, because you have equity in your home, right? You're putting 20% down, you might have a little bit more equity in the house, you might have 30%, 40%, whatever the case may be, right? You'll get the car loan.
Yeah.
But when it comes to houses, the first thing I always tell people is the biggest thing for the youngest generation out there is, please focus on keeping your monthly payments as low as possible. Your OSAP, if you have a little bit of extra money, try to pay it off as much as you can, or call in OSAP. One of the biggest things I've been doing now with a lot of my new buyers is telling them, okay, you don't have 30, 40,000 to pay off the OSAP, but when it hits your the credit bureau, it's showing the monthly payments as $300-400. Call OSAP, make that, I think it's a mandatory payment that you have to do after a certain 6 months grace period or whatnot.
Yeah.
Call in OSAP, ask them to lower the payment, lower it to $100, $120, exactly, right? So if they're able to do that, their monthly obligation is now less. So it helps in the ratios of their mortgage.
Yeah.
So the biggest thing I think that millennials are having now is not too much of the income, it's not too much of the down payment. They're either saving and getting the down payment or getting it gifted from family. But the biggest thing is not realizing that adding the debts before going for a mortgage hurts.
Yeah.
And I think the biggest reason as to why is because a lot of the young generation is still split between, am I going to rent or am I going to buy? And so they make these rash decisions of, I'll pay OSAP later, I want to buy a car, right? And they don't focus on the 2-3 year planning, right? When you're looking for a mortgage, you have to be planning ahead of time. You have to make sure your taxes are straight, your income is going to be there. Sort of look at the price range you're looking at, the down payment needed for that, right? What debts do you have to eliminate in order to get approved? So the focus has to be in the planning process rather than, okay, I'm buying a house tomorrow, let's see what we can get.
Yep.
Right? And that's the biggest difference. I think not even just the millennial generation or Gen Z, I think even
everybody
older,
goes in the housing market. I think you mentioned very valid point of planning.
Right.
I think one of the reasons that LifePlan exists today is because of the planning. I mean, we
100%.
focus on, it could be not 100-page of financial plan itself, but as a strategic or tactical plan of 1 page, understanding where you are and what you need to be going. And the most important, understanding the difference between the needs and wants.
Exactly.
So where that
biggest point.
biggest thing is, I notice that, I mean, we see that every day clients or our advisors clients coming through these challenges, they bought certain things because they want, and I wouldn't say they're greedy, but it's a want of showing to society and being in an external person, but they forget about the needs. And that's what the issues are, like point A to point B. You had to really look at, leaving that, what is actually going to help you, and in terms of
100%.
So then it really is a matter of needs and wants, and the planning is a key point. So you have when they're looking for the mortgage, or the lending part to get in there. So first episode we had a B2B bank, Rohan Bakshi.
Perfect.
We talked about how they can actually borrow from RRSP loans for supporting 70,000 for down payment. So now we're going, we talked about the TDSR, GDSR, so that's perfect. So let's talk about three lenders difference. Give us a little, our audience, kind of simple terms, what are the three lenders, why that they had to be looking at these lenders?
Okay, so the little bit of a breakdown. Just to say it, and then we'll go into each one. Let's call them Tier 1 banks, so the Schedule A banks. B banks are some credit unions and some other banks that take on more debt, and I'll go into the detail of that. And then finally, at C, you have the private lenders, okay?
Yes.
So the differences between each. For A, okay, you're looking at the Schedule A banks, Tier 1 banks, the 5 major banks, good credit unions that are giving you the best rates, obviously, and why that is because you're a AAA client. So, good income, no debts or very minimal, right? And you have solid down payment, right? So, three things that they're sort of looking at in aspects to what you're going to be going for, right? And not only just down payment, but you can even do less than 20% down payment, but more importantly is your credit score,
Yeah.
right? To get into the A, it's 680 plus beacon score,
Mm-hmm.
right? That is your A market,
Yes.
right? These are people who can walk into any branch, any
They can
bank.
negotiate the interest
Exactly.
rate and
They
get
can,
all
they
the
can sit
perks.
there and
Yeah.
they have all the cards in their hands,
Yeah.
and the bank pretty much has to bow down to them,
Yes,
right?
yes, yes.
So then we move to the B side. The B side is what has picked up a lot, and once again, that's where my career shifted from working for tier one, moving to the broker realm, is because I wanted to service all clients. I realized not everyone was, some of them could have made it to A, but are just off,
Mm-hmm.
and they have to go to B,
Mm-hmm.
right? So when you go to B, I want to say a bulk of that business is self-employed individuals,
Okay.
individuals with multiple properties.
Mm-hmm.
Because of the new stress test,
Mhm.
a lot of individuals before were able to buy 3, 4, 5, 6, 7, 8 homes,
Yeah.
right? And they just have to get qualified for whatever the 5-year fixed rate was that they were going
Mhm.
for.
Mm-hmm.
Now with the stress test, it makes it much more difficult to get into A.
Mm-hmm.
So a lot of them are falling into B.
Mm-hmm.
2 reasons. One, obviously the debts are higher. You have a bunch of mortgage loans, right, on 1, 2 properties, and maybe you're buying your third one,
Yeah.
right? Whatever the case may be. Do a little bit of rental offset, work with
Mhm.
your income, but the ratios are going to be pretty high
Yeah.
compared to when it was just doing it on the A side and there was no stress test, right? So now it's like you have to qualify for double the income, pretty much, to get what you were getting before.
Mm-hmm.
And another part of that is the bulk of the business is self-employed individuals, right?
Mhm.
There are a lot of individuals that are self-employed making over 6 figures, and the issue there is obviously
Stated-
nobody wants to pay the taxes.
The
Right?
stated income versus the
Stated
real
income,
right? Yeah.
stated income, right? Rather than saying, hey, here's my last 2 years at NOA showing $250,000, right? We go, hey, here's 6 months bank statements, but if you ask me for my NOAs, they probably already showed 30, 40, 50K, right?
Yeah, yeah.
So
that's a reality.
It's
yeah.
it's a reality, right? You know, with the write-offs and business expenses, whatever they do, right?
They deserve. I mean, they work hard and they
100%.
have expenses to
100%.
write off, and they taken the risk of as
Yeah.
an entrepreneur, right? Yeah,
And-
definitely. Yeah.
And I think the biggest thing also is, like you were saying, it's not telling the client what they want to hear. It's about educating them on what they need to hear,
Exactly.
right?
Yeah.
So that's where I guess the success of my business picks up. Is I differentiate myself because I will explain to the client what their options are
Mhm.
and why they have those options. So certain,
Absolutely.
you know,
Yeah, yeah.
when self-employed, you
Mhm.
might tell someone, hey, you might have to pay 1% higher on your interest rate compared to an A bank,
Mm-hmm.
but you have to rationalize why,
Yeah.
right? I have to explain, you know, Mr. X,
What are you getting out because?
right,
Of, yeah.
you know,
Yeah.
you're saving yourself maybe 15% in taxes. Okay, you're paying 1% higher on the rate and 1% to the lender. Okay, you have a 2% cost in doing this mortgage. Out of the 15% that you're saving in your taxes, net that, you still have 13% of your overall net worth
Exactly.
and money in your pocket.
Okay. So the finance is a common sense, but
Finance
it's common sense is not very common.
But it's very, exactly, because you know when you tell somebody, hey, you need to go to B because everyone's expectations, I want to be A. right?
Yeah, yeah.
They have good income. Obviously, the business is doing well.
Yeah.
Not on NOA, but the business is doing well. They have good credit, right? Most of the time. But once again, it's the debt ratios, right? It's because they're not showing that income; they're stating it.
Yeah.
We have to work with what we can show.
I'm just quickly interrupt you here.
Yeah, yeah.
I think I had this stigma before I became a financial planner,
Okay.
before I get in this industry. So
Yeah.
when I heard about A lender, B lenders, I thought, oh no, I want to be A lender. But the idea
Right.
here is somebody giving us money. Doesn't matter, it's A or B or C.
That's-
as long
that's
as it makes sense for what our need is. Again, going
Exactly.
back to the need.
Yeah.
And understand the mathematics of the
Of
numbers,
why.
you know, why I'm paying for this extra
Mhm.
income, extra interest rate, and
That's it.
etc. That's fine. But
Exactly.
when we need to be so careful when we investing in the money, do we investing in A or B or C?
Right.
So which is what our financial planners or the other professionals can help the people. But
And
anyway,
that,
continue with
that's
that.
actually a really good flow into the last category, which is
Mhm.
C,
C.
private.
Exactly. Mhm.
So private, you touched on both sides there. You
Yes.
said the risk for the person giving the money,
Yes.
and then you also talked about investment. So we'll get into that. But so the risk,
Mhm.
right? It's having the client understand why sometimes they may need to go to private. A lot of the clients that do purchases that end up in private is because they haven't planned once again planning, they haven't planned properly for the mortgage closing, right? They thought maybe 2 years ago, 1 year ago, I put the down with the builder. All of a sudden, 2 weeks before closing, they come, they're like, hey, builder's not doing extensions, I need to close, da-da-da-da-da. My wife just, switched jobs a month ago. It's a whole different maternity leave, whatever the case may be. I can't sell this house right now. I need 3 months, and then I can sell it and put the down for the new place. Yada yada yada. It was wintertime. I didn't get to list it. There's a lot of things that can happen, right?
It happened so many people,
So
and
much.
I knew so many people. Lost so much the down payment, hard-earned money, without having the right planning in place in the first place.
That's right. So I pride myself on trying to follow up with clients every month, every couple months prior to the closing, because I want to make sure they're on track with no hiccups near the end.
Yeah.
So clients I guess they didn't do the planning and they were referred to me or coming from other brokers. They maybe had a sour relationship with or whatnot. So in these cases, we have to sometimes temporarily put them in private. 3 months, 6 months, maybe a year sometimes, right? Depending on what their situation is, why they're in that situation, or if it's just a means of being very poor credit.
Yeah.
Right? Because even in the B banks, yes, they will take higher debt ratios, they will take a lower credit score individual, but only to a certain limit.
Yeah.
Right? So private, they don't really look at credit scores. They don't really look at your income. All they care about is the equity of the home. Where is the home located? Right? Doesn't matter if it's a primary residence, doesn't matter if it's a rental property, right? They might have a slight fluctuation on rate if it's a rental. Now, with private, pitching that to a client, one is making them understand why we're in that. Two, holding their hand and giving them the confidence that you're going to get them out of that situation in 3 months, 6 months, 1 year, whatever the case may be.
Absolutely.
And third is telling them the rationale and the reasoning, once again, like you mentioned, is what is the risk to the lender? Because like you mentioned, they're the one giving the money, right? So sometimes clients don't understand, why am I paying high interest rate? Why is it interest only? Why am I paying so much in lender fees, right? When it comes to private, it's a risk. It's at the end of the day, clients, I have to tell them, you have to sort of realize we're not talking about a bank. Right? We're not talking about a tier 1 bank that has billions of dollars that can lend just at a great rate. The lowest thing is that, hey, these are investors. Investors need to make a certain return. The company, being a lending company, needs to make a certain return, right? So you're paying for that return initially, right? Until you fix your situation, because you couldn't get an A, you couldn't get an B. We have to go to private for whatever the case may be. Life happens, right? But now because you're in C, in private, you're risking somebody's money. Someone's risking their money
towards your
put
situation.
Towards your situation, to see the potential that you can get out. Right? They don't want you to renew in private either. They want you to be out. Right? They would rather give their loan to somebody else. So nobody wants to see you in private. Nobody wants to be in private. So it's working together to get out of there, pretty much.
I think it's very well said. I think there's really lots of misconceptions,
100%.
and a lot of people burn themselves on the private lending, rushing into, I don't have a time. Okay, give me where you sign. Okay, sign.
I have to look at the
and
contracts.
then go back and then look at it. Oh, they did this, and I think one of the truth about why we talk about naked money. This is not a financial advising place. We actually helping you to awareing of the situation. You need to talk to the right professionals, do the due diligence of the people that you're dealing with.
Right.
We cannot help 320 million Canadians.
I wish we could.
A lot of people we have out there. There's a lot of professionals out there. Talk to them. Understand what you're getting into. Don't rush into making that. When we going traveling south of the border, especially like the weather like this, we spend so much time about reading the reviews and looking at the properties, and spend more time on looking at those. But when we're making the biggest financial decision, it could be insurance, investments, or the mortgage, or any other financial planning areas, we don't take a time. We don't do the due diligence. We just listen to uncles and
there you go, right?
Somebody says this. You need to put that trust in the people who has done the work and done the proper due diligence, and then they continue to be educating themselves and being continue learning those people you want to be put the trust on, and ask questions. There's no stupid question. There's no
never,
bad questions.
never.
Ask any question that you have, because you have a right to ask the questions,
And
right?
it's not only that, they're not the expert in this field, right? They're coming to you and I,
Yeah, that's
and
right.
our job is to answer every single question, to make sure that they're confident in the purchase or in this investment that they're about to do, whether it's insurance, whether it's investments, whether it's the mortgage.
Yes.
Right?
So let's talk about the last, wrapping up the conversation today. I know we can talk for the rest
We
of
can
the
take
day.
forever, yeah.
Yeah. So let's wrapping up this conversation. Tell me about the people. I mean, we talked about the credit score. We talked about the lending different criteria. What are the things they need to be cautious about when they're signing up any of these documents, getting into
Reading the contracts, or having the broker or their lawyer reviewing the contracts,
Okay.
knowing, hey, here's what it costs to do this mortgage. Here's what it costs to break the mortgage. Here's what it costs to renew. Here's what it costs to discharge. There's a lot of nitty-gritty, fine details in the lines that not a lot of people pay attention to. And I think that's one thing that everyone needs to do, is to pay attention to the costs of the mortgage from beginning of funding to the end when they're getting rid of that mortgage.
Okay.
There's a lot of fees that I've seen on contracts, especially in privates, that end up in the back end that they only find out about when they're discharging that mortgage, and
Yeah.
they get hit with a bunch of fees.
Yes. Yeah.
Because the front looks very nice, but
Yeah.
the back isn't.
Back isn't. Yeah. So then definitely they need to talk to the right lawyers
100%.
who has understanding about this details about.
And in this industry, or
Industry.
even dealing with privates and whatnot,
Yeah,
right?
yeah.
Not just ones that deal with banks every day.
Yeah.
So
Definitely, I think
Yeah.
the takeaway is understanding not only when you get in, if you need to get off the mortgage or renewing the mortgage or discharging the mortgage, or if life happens and things happen in the middle of the way, what is going to happen to your mortgage, it's the
Yeah.
money.
big time.
And beyond that, work with the planning. Sit down and look at the cash flow, what is going out, understanding your wants and needs,
Yep.
right? So then understanding that is the important part. We will be having one of the chartered accountant. He focus on real estate investment. So
Amazing.
we'll have a pivoting into the next subject in upcoming podcast. Stay tuned. And thank you for joining The Naked Money, and thank you, Abi, for coming, taking your time, and
Thank
especially
you.
with the crazy weather today. So that you take
No
your
problem.
time and
Thank
coming
you.
here.
Thank you.
And make sure you subscribe the button below in our YouTube channels, and follow other social media platforms if you want to hear more about this. And please feel free to reach out to us if you want to know more about these particular topics or any other financial concerns that you have. We can able to give you unbiased advice and naked truth about money. And thank you for tuning in. Have a good day. Bye.